In 2018, at the Berkshire Hathaway annual shareholder meeting, Warren Buffett, the most successful investor in the history of the stock market, looked into a room full of his followers and said two words about Bitcoin that have defined the debate ever since. He called it rat poison squared. His partner Charlie Munger, who sat beside him for over 50 years, went further. He called crypto trading just dementia. In 2022, Buffett doubled down. He said that if you told me you own all of the Bitcoin in the world and you offered it to me for $25, I would not take it. Because what would I do with it? I would have to sell it back to you one way or another. It is not going to do anything. $25 for all of the Bitcoin in the world. He would not take it. The greatest investor alive, the man whose track record from 1964 to 2021 beat the S&P 500 by more than 100 times, looked at Bitcoin and saw nothing, less than nothing, rat poison. And here's the problem. Since the day he said rat poison squared, Bitcoin has returned over 700%. Since 2014, when he first called it a mirage, Bitcoin has returned over 16,000%. And his own company, Berkshire Hathaway, now holds over $1.2 billion in a Brazilian fintech company called New Holdings that operates its own cryptocurrency platform where millions of users buy, sell, and hold Bitcoin, Ethereum, and other digital assets every single day. The man who said he would not take all the Bitcoin in the world for $25 is profiting from a company that sells Bitcoin to millions of people. Something does not add up. Today we are going to figure out exactly what it is. Either Warren Buffett is wrong about Bitcoin, which would be one of the most consequential investing mistakes of all time, or the rest of the world is wrong and Bitcoin really is rat poison that has somehow returned 16,000% to the people who swallowed it. If you want to understand this debate at a level deeper than any headline has ever taken it, subscribe and hit the notification bell. This video is going to challenge what you think you know about the greatest investor alive and the most controversial asset on the planet. Well, let me start by giving Buffett his due. The man is not stupid, and treating him as if he is would be dishonest. Warren Buffett's investing framework is built on one principle that has guided every dollar he has ever deployed. He buys productive assets. An asset is productive if it generates cash flow. A farm produces crops. A factory produces goods. A company produces earnings. Apple produces iPhones that generate over $90 billion a year in revenue. Coca-Cola produces beverages that generate $45 billion. These companies take raw materials, add value through labor and innovation, and produce something that people pay for. The cash flows from that process are what make the investment valuable. Bitcoin does not do this. It does not produce earnings. It does not generate revenue. It does not manufacture anything. It does not pay dividends. A single Bitcoin sitting in a wallet today will be the same single Bitcoin sitting in the same wallet in 50 years. It will not have grown, produced, or generated anything. From Buffett's framework, that makes Bitcoin identical to gold, which he also dislikes. He once said that all the gold in the world could be melted into a cube roughly 68 feet on each side, and if you owned it, you could sit there and look at it, but it would never do anything. Meanwhile, for the same money, you could buy all the farmland in America, plus 10 ExxonMobils and still have $1 trillion left over. The farmland produces food. ExxonMobil produces energy. The gold cube just sits there. Bitcoin, in Buffett's view, is an even worse version of that gold cube. At least gold has industrial uses. At least gold has been a store of value for 5,000 years. Bitcoin has existed for 15 years, and its only function is to be bought and sold by people who hope the next person will pay more. That is a logically consistent argument, and it is the argument that has kept the greatest investor of all time on the sidelines while Bitcoin went from zero to over $126,000 at its peak. Now here is where the argument breaks. If you are finding this valuable, hit the like button and keep watching, because I am about to show you 3 things that Buffett's framework cannot explain. The first thing Buffett cannot explain is why his own rule is the single most accurate Bitcoin buy signal in history. In his 2004 letter to Berkshire Hathaway shareholders, Buffett wrote 10 words that became the most famous investing rule ever written. He wrote these words: "Be fearful when others are greedy, and greedy when others are fearful." That rule was not written about Bitcoin, but it works for Bitcoin better than it has ever worked for any other asset. Let me show you the data. The Crypto Fear and Greed Index measures how scared or greedy investors are on a scale of 0 to 100. Every time this index has dropped into extreme fear territory and stayed there for weeks, Bitcoin has produced returns that would make any Berkshire Hathaway shareholder weep with envy. In December 2018, the fear index dropped into the teens. Bitcoin was trading at approximately $3,200. Everyone said crypto was dead. Within 3 years, Bitcoin hit $69,000, a 2,050% return. In March 2020, the fear index dropped to single digits during the COVID crash. Bitcoin was below $5,000. Within 2 years, it hit $69,000, over 1,000%. In June 2022, the fear index sat in the teens for weeks after FTX collapsed. Bitcoin was at $17,000. Within 18 months, it hit a new all-time high above $126,000, over 600%. In February 2026, the fear index hit 5, the lowest reading since tracking began. Bitcoin was around $60,000. It has already climbed back towards $70,000, and the recovery may just be beginning. This pattern has a 100% hit rate. Maximum fear, everyone sells, smart money buys, new all-time highs follow. Every single time, without exception, for the entire 15-year history of Bitcoin. Warren Buffett wrote the rule: Bitcoin follows it more faithfully than any stock in his own portfolio ever has. The greatest irony in the history of investing. The second thing Buffett's framework cannot explain is currency debasement. Buffett's productive asset argument assumes that the currency in which you measure those assets holds its value. A farm is productive because it generates dollars. Apple is productive because it earns dollars. But what happens when the dollars themselves are losing value? Ray Dalio, who runs in the same circles as Buffett and who has studied the same 500 years of financial history, sees the world very differently. At Davos, in January 2026, Ray Dalio put it plainly: do you print money or do you let a debt crisis happen? He added, we're increasingly buying our own money. That's the lesson of all this. The United States national debt is $38 trillion. The currency is being debased at approximately 8% per year through money supply expansion, on top of measured inflation of 3 to 4%. That gives you a total purchasing power erosion of roughly 11% annually. Buffett's Berkshire Hathaway is sitting on over $325 billion in cash and U.S. Treasury bills. That cash is earning roughly 4 to 5% in Treasury yields. But if Dalio is right about the 11% hurdle rate, Buffett's cash pile is losing 6 to 7% of its real purchasing power every single year. $325 billion quietly evaporating at $20 billion a year in real terms. Bitcoin was designed specifically to solve this problem. 21 million coins, fixed forever. No government can print more, no central bank can debase it, no emergency funding request can expand the supply. In a world where every fiat currency on earth is being deliberately devalued, an asset with a mathematically fixed supply is not rat poison. It is the antidote. Buffett does not see it this way because his framework was built during an era when the dollar's dominance was unchallenged. But the world has changed. The petrodollar system is fracturing. BRICS is building alternative payment infrastructure. Iran is charging yuan tolls through Hormuz. The dollar's share of global reserves has fallen from 72% to under 58%. And central banks are buying gold at the fastest rate in decades, precisely because they are losing confidence in the currency that Buffett's entire fortune is denominated in. The third thing Buffett cannot explain is BlackRock. If you want to share this video, now is the moment. Because what I am about to say should end the rat poison debate permanently. BlackRock is the largest asset manager on earth. $15 trillion under management. They are the most conservative, most regulated, most institutionally careful financial entity in existence. They do not launch products for fun. They launch products when they see decades of demand. In January 2024, BlackRock launched a spot Bitcoin ETF. It became the fastest growing ETF in the history of financial markets. Within months, it held tens of billions in assets. By early 2026, total spot Bitcoin ETF assets exceeded $93 billion. And in the middle of a war, during a blockade of the Strait of Hormuz with the fear index at 8, BlackRock's IBIT fund pulled in $380 million in a single day. On the same day that investors pulled $13.6 billion out of the S&P 500 ETF and $2.26 billion out of gold, BlackRock called Bitcoin a non-correlated macro hedge during periods of equity and commodity stress. That is the world's most powerful financial institution, directly contradicting the world's most famous investor. One of them is wrong, and the money is voting with BlackRock. Now here's where I need to be fair. This is not a hit piece on Warren Buffett. The man has made more money for more people over more decades than any investor who has ever lived. His track record is unimpeachable, and his productive asset framework works brilliantly for what it was designed to evaluate: cash flow generating businesses in a stable monetary system. The problem is that the monetary system is no longer stable. Dalio says the monetary order is breaking down. The national debt says it is unsustainable. The petrodollar says it is fracturing. And every central bank buying gold at record pace says they agree. Buffett's framework was built for a world that is disappearing. Bitcoin was built for the world that is replacing it. And here's perhaps the most telling detail of all. Buffett himself seems to sense that something has shifted. In a shareholder meeting, he said that there could be things happen in the United States that make us want to own a lot of other currencies. He did not specify which currencies, but the acknowledgement that dollar dominance might not last forever is a crack in the foundation of every argument he has ever made against Bitcoin. Let me now give you the numbers that put this entire debate in perspective, because numbers do not have opinions. $10,000 invested in Berkshire Hathaway in January 2016 is worth approximately $27,000 today. That is a 170% return over 10 years. Excellent by any traditional standard. $10,000 invested in Bitcoin on the same date is worth approximately $1.6 million. That is a 16,000% return. Berkshire Hathaway's total market capitalization is roughly $1 trillion. Bitcoin's market cap is approximately $1.4 trillion. The asset Buffett called rat poison is now worth more than Buffett's entire life's work. That does not mean Buffett is a bad investor. It means his framework has a blind spot. He evaluates assets based on what they produce. Bitcoin is not designed to produce. It is designed to preserve. In an era where preservation of purchasing power is becoming more important than production of cash flow, that blind spot is becoming expensive. Charlie Munger, who called crypto dementia, passed away in November 2023. He never changed his mind. Buffett stepped down as chief executive officer of Berkshire Hathaway in May 2025, handing the role to Greg Abel. Analysts say Abel is unlikely to shift the company's stance on crypto. The philosophical opposition to Bitcoin will outlive both founders. But the market does not care about philosophy. The market cares about math. And the math says that an asset which cannot be printed in a world where everything else is being printed at 8% a year has a very specific and very large role to play in the future of finance. Buffett wrote the rule: be greedy when others are fearful. The fear index is in single digits. Institutions are buying billions while retail panics. The pattern has never failed. The greatest investor alive gave you the playbook. He just refuses to use it for the one asset that follows it most perfectly. That might be wisdom, it might be stubbornness, but 16,000% says the market has already decided. If this changed how you think about Buffett and Bitcoin, subscribe, hit like, and tell us in the comments. Is Buffett wrong about Bitcoin, or will he be proven right in the end? We read every comment, and we will see you in the next one.